For nearly 6 decades, Warren Buffett, the CEO of Berkshire Hathaway, has outperformed the broader market with remarkable consistency. While the S&P 500 has seen significant growth, Warren Buffett's leadership has propelled Berkshire's Class A shares to extraordinary heights, increasing by over 4 million % since the mid-1960s. With such an impressive investment record, Buffett has amassed a devoted following, with many investors eager to emulate his strategies. And in 2024, Buffett has placed significant bets on several stocks, but we will only look at the top 5. So, which stocks is Warren Buffett interested in? And what makes them so lucrative? Join us as we explore Warren Buffett's top 5 stock picks for 2024. Discover which stocks he's betting big on and what makes them so lucrative to add to your portfolio. 1. Bank of America. Warren Buffett's affinity for bank stocks remains strong, with several major positions in Berkshire Hathaway's portfolio dedicated to banks and financial institutions. Leading the pack is the Bank of America, which holds the title of Buffett's favorite bank and his largest bank holding. Berkshire Hathaway currently owns over 1 billion shares of BAC stock, valued at a whopping $36 billion. Buffett's admiration extends to the Bank of America's CEO, Brian Moynihan, who he has publicly praised. Despite occasional underperformance, Buffett has maintained his stake in Bank of America while divesting from other lenders in recent years. Despite modest share prices, performance over the past year, and a 16% increase over the last 5 years, Buffett's confidence in Bank of America remains unwavering. Their most recent earnings report fell short of expectations, revealing a Q4 profit of $2.84 billion, or 35 cents per share, which was below analyst forecasts of $4.38 billion, or 53 cents per share. This represented a significant decline of 59% from the previous year. Moreover, the lender's revenue came in at $21.96 billion, missing forecasts of $23.7 billion, with an overall sales decrease of 10% compared to the previous year. Management attributed these disappointing results to regulatory changes incurred since the summer, including a $250 million fine related to junk fees. Despite these challenges, Warren Buffett remains steadfast in his belief in Bank of America. 2. Apple. Following the first trading day of the new year, Apple has held a dominant position in Berkshire Hathaway's $362 million investment portfolio, comprising nearly 47%. Despite already being a significant part of Berkshire's holdings for years, Warren Buffett and his team continue to show confidence in Apple by purchasing over 20 million additional shares last year. The company aligns with the key criteria that Buffett and his investing lieutenants, Ted Weschler and Todd Combs, see in a company. It boasts widely recognized brand name products and services, is led by a trusted management team, demonstrates high profitability, and enjoys an exceptionally loyal customer base. These factors contribute to Apple's enduring appeal as a cornerstone investment for Berkshire Hathaway. In particular, Apple's iPhone has secured over half of the US smartphone market share, showcasing its dominance in the industry. The company's services segment is also experiencing rapid growth, driven by a shift towards subscription-based services. This transition will boost Apple's operating margin and mitigate the sales fluctuations associated with iPhone replacement cycles. And don't forget, they released the new Apple Vision Pro, which seems to be the future of tech. And when it comes to their capital return program, it's unparalleled among publicly traded companies. As the world's largest public company by market capitalization, Apple is distributing $15 billion annually in dividend payments and has repurchased over $600 billion of its common stock since the beginning of 2013. This commitment to returning capital to shareholders underscores Apple's financial strength and commitment to creating value for investors. 3. Occidental Petroleum. Warren Buffett's substantial investment in Occidental Petroleum in 2024 is unmistakably significant. Berkshire Hathaway accumulated over 49 million shares of Occidental's common stock in 2023, gradually building a position of 243.7 million shares over the past 2 years. Buffett and his team's strategic move isn't arbitrary. They're placing a significant bet on the spot price of crude oil to either remain high or increase further. Factors such as Russia's invasion of Ukraine in February 2022 and reduced capital expenditures by global energy companies have contributed to a tightening of the global oil supply. This tightening is expected to positively impact the spot price of crude oil, providing a favorable outlook for Occidental Petroleum and Buffett's investment. What sets Occidental Petroleum apart is its heavy reliance on drilling activities. While it operates chemical plants and is considered an integral oil and gas company, a significant portion of its revenue comes from drilling operations. This puts Occidental in a favorable position, especially if the spot price of crude oil remains elevated or continues to rise, as it would significantly boost the company's cash flow. However, it's important to note that Occidental's balance sheet raises some concerns. Despite reducing its net debt by over $17 billion following the acquisition of Anadarko, it still holds a substantial $18.6 billion net debt. So, Occidental's availability to navigate its leveraged balance sheet would greatly benefit from a sustained high spot price for crude oil, improving its financial flexibility. And with Warren Buffett's increased faith in the company, something tells me that number will soon turn into a profit. 4. Capital One Finance. In addition to Bank of America, Warren Buffett is making a significant bet on financial services provider Capital One Financial in 2024. Berkshire's investment team acquired just over 9.9 million shares of Capital One during the first quarter of 2023. Followed by an additional purchase of around 2.55 million in June. As of the beginning of 2024, this position was valued at over $1.6 billion. Buffett's sizable investment in Capital One, similar to Bank of America, seems to stem from a belief in the company's cyclical nature and intrinsic value. Capital One is renowned as one of the largest credit card issuers in the nation, and as of December 2023, the company held $144 billion in credit card loans on its books, with $137.5 billion attributed to the United States alone. With the U.S. economy showing resilience against recessionary concerns and the national savings rate declining, Capital One's financial credit card services segment has thrived in an ideal operating environment. One important thing to consider is that Capital One's loan portfolio leans more heavily on subprime borrowers than the average U.S. lender. In the event of a contraction in the U.S. economy, historically, subprime borrowers are more prone to default on their payments. This aspect introduces a level of risk for Capital One if economic conditions deteriorate. Moreover, certain financial indicators suggest that 2024 could pose challenges for the U.S. economy and stock market. However, despite these potential headwinds, Capital One Financial presents some enticing aspects. Like Bank of America, Capital One is trading close to its book value and boasts a forward-year earnings multiple of less than 10, making it an attractive prospect from a valuation standpoint. 5. HP. Berkshire Hathaway initiated its investment in HP during the first quarter of 2022, eventually disclosing ownership of 121 million shares in April. The announcement led to a 15% surge in the share price, resulting in a quick unrealized gain for the holding company. However, Berkshire has since reduced its stake in HP but is still among the top 5 holders of the company with BlackRock. HP's appeal extends beyond its attractive valuation, with a forward earnings multiple of 8.8 times. Additionally, the company has a reputation for rewarding its shareholders, as evidenced by a 5% increase in its quarterly dividend in October 2023. Following a similar hike in November 2022, HP's dividend yield stands strong at a healthy 3.65%, surpassing double the dividend yield for the S&P 500 index. In addition to distributing over $1.0 billion in dividends in fiscal 2023, the company also repurchased $100 million of its stock, bolstered by $3.6 billion in cash reserves at the end of its fiscal year. HP is well equipped to maintain its robust dividend payout. This, along with its consistent performance, solidifies HP's position as one of the best Warren Buffett dividend stocks. Interestingly, he remains content to receive dividends while patiently awaiting the stock's rebound. Moreover, Argus Research analyst Jim Kelleher maintains a buy rate on the stock, setting a $40 price target, which represents a promising 32% increase from its current trading price. According to Kelleher, the main risk for HPQ is the possibility of an economic downturn leading to a corresponding decline in PC and printer sales. However, he remains optimistic about the company's ability to navigate potential challenges. Kelleher believes that HPQ possesses the financial strength, market leadership, and growth characteristics necessary to withstand such a storm and emerge as a stronger player in the industry. Now, apart from that, what can we learn from Buffett's investments? Well, his investment philosophy revolves around buying and holding onto great businesses for the long haul. He famously stated, "If you're not willing to own a stock for 10 years, do not even think about owning it for 10 minutes." This philosophy underscores the importance of patience and long-term thinking in investing. Investing often rewards those who are patient, particularly when it comes to dividend stocks and their potential for long-term growth. Consider this scenario. If you invest $1,000 monthly into a stock with an average annual return of 8%, you would accumulate over $549,000 after 20 years, despite only investing $240,000 of your own money. Thanks to the power of compounding. Now, let's add dividends into the mix. If the same stock has a steady 2% annual dividend yield that you reinvest each year, the value of your investment would grow to around $687,300 after 20 years. This highlights how reinvesting dividends can amplify the magic of compound earnings, further enhancing the growth of your investment over time. Indeed, consistent investing over time makes it possible to build a dividend portfolio that will make you rich as soon as possible. By diligently investing in dividend-paying stocks and reinvesting those dividends, you can gradually increase your portfolio's value and income. Over time, as your portfolio grows and your investments mature, the dividends received can provide a steady income stream to support your lifestyle. This approach allows you to enjoy the benefits of compounding and the reliability of dividend payments, ultimately helping you achieve financial security and independence. Now that we've explored a variety of Buffett's investment stocks, what are your thoughts on building a dividend portfolio? Are you ready to embark on this journey towards financial freedom? Share your thoughts in the comments below. And don't forget to give this video a thumbs up and subscribe to our channel for more insightful content.